Welcome to the Chinchilla Picking Podcast. It is April 13th, 3:25 p.m. We want everybody to be uplifted, educated, and entertained. I think that's what Dave says. I usually fall asleep in the first part of it. So I can't remember. We're 200 episodes through this thing almost. And listeners might remember what he says. Educated, uplifted, and entertained, I think. And we want everybody to make money. Yeah? Okay. Well, anyways, Dave is not here with us today, obviously. Not here to provide the other side of the tariff argument and make us a little bit more balanced, which is very unfortunate for those of you who are wrong. I could see how that would be very upsetting. But I do want to get into the tariffs a little bit more. We had some more news come about the past week in regards to tariffs, and even more news yesterday. So I want to get into that, but I also kind of want to go through the beneficiaries of the tariffs, because we've been talking a lot about the negatives and about who's going to be hurt by this, not so much about who's going to benefit. And maybe we need to change our investment rationale, because I don't think that this is going to go away, not for the next 3.5 years at least. Thinking about what can we do to minimize the negatives and the impact that this has on our portfolio. Now, yesterday, smartphones and other tech products won an exemption. Actually, that was Friday night, and that was an exemption from the latest so-called reciprocal tariffs. But today, we kind of got some cold water thrown on that by Commerce Secretary Howard Lutnick, where he said this is not a permanent sort of exemption. They're just putting an exemption on this while they can investigate what they should do about semiconductors. Now, we have a president here in the United States that back in October said that tariffs is the most beautiful word in the English dictionary. So these aren't going away. I think we just kind of kick things down the road. I would assume, though, that tomorrow Apple, Nvidia, and Microsoft and some of these other semiconductor companies as well are probably going to have a boost tomorrow. And if you want to kind of take some of your gains off the top, I wouldn't sell all of the stocks. I'm not in a panic. People think I'm in a panic. I'm not. This is, something that we're going to get through. Any kind of issue that results from these tariffs, we're going to get through it. If these tariffs wind up being a mistake, like I think they will be, we'll change policy. I'm betting on that. This has happened in the past, and we've gotten through it, and I don't see how that's going to be any different in the future. But there's a lot of people that think now that, with the tariffs that were paused for 90 days, that this is a dramatic lowering or reversal of the president's policy. It's not. In fact, tariffs are essentially what the consumers are having to pay, at least at the end of this. What's being passed down to us is essentially the same. There's very little difference in it. Consumers are now facing an overall average U.S. effective tariff at a rate of 25.3%, the highest level since 1909. That's according to the Budget Lab Research Center that analyzes federal policy proposals, the largest effective tariff rate since 1909. This is higher than Smoot-Hawley, higher than the Great Depression, the highest that it's been since 1913 when the Federal Reserve was created. It's not good. It's really not good. In my opinion, I don't like it. This is disproportionately affecting clothing and textiles. Now, people say that that's not a big deal. It's not like, it's affecting, guns or defense for the military or, anything like that. But, listen, you got a kid that's going back to school in the fall and you got to do back to school summer shopping. That's a problem. That's a problem for a lot of U.S. consumers. They estimate that prices will increase 58% for apparel, 40% for textiles, and that's going to be in the short run, and then remain 26% and 17% higher respectively. Motor vehicles, they say, will rise 13% in the short run and 18% in the long run. That's an equivalent of $8,700 to the price of an average 2024 new car. Great. I'm now in the market for a new car right now. This is perfect for me, right? $8,700 more. The climb down on Wednesday, it didn't change the sector-based tariffs much. Those tariffs include a 25% duty for cars, some automobile parts that went into effect last week, as well as 25% levy on steel and aluminum imports. A lot of people say buy General Motors because those cars are assembled here in the United States, but the problem is the parts aren't. A lot of the steel comes from other countries. A lot of the parts come from other countries. I'm kind of staying away from General Motors. If somebody wants to buy into it because the price-to-earnings ratio is so low, it's at like a 6%, then fine. I think there's better opportunities out there than General Motors, though. Looks like they're going to impose other sectoral tariffs as well, such as pharmaceutical remains in the future. Food prices should rise around 2.5% in the short run, 2.9% higher in the long run. Fresh produce is initially being estimated at 5.4% higher prices, and they say that in the long term that'll stabilize at 3.7% higher. So not good news. It's still not good news. People are going to react positively on Monday, hoping that we're completely reversing course, but we're not. Ray Dalio, founder of hedge fund firm Bridgewater Associates, said Sunday the U.S. economy could easily be pushed into a recession because of the trade war. He said, I think right now we're at a decision-making point very close to recession. He said that on Meet the Press today, actually. And he outlined what he sees as risks from growing U.S. debt, potential brewing international conflicts, and so on. So the economic backdrop is so fast-moving. This is from Jamie Dimon, the CEO of JP Morgan Chase. So fast-moving that he rang up his U.S. chief economist, Michael Feroli, and said that he called him specifically to ask him how they're looking at their forecast now, and they said that it's about a 50% chance for a recession. And this was on the earnings call on Friday. The analyst asked him, what do you think about, our chances for going into a recession? He mentioned what Michael Feroli, I'm not pronouncing that right, but I don't know how I can't say that. Feroli. Feroli. That's got to be right, I would think. But anyways, he referred to the call that he had with Michael Feroli. He said, I'm going to refer to that 50% shot. Now, a different firm that reported on Friday, they said that a top executive was frustrated. He said a lot of his metrics that his company put out there were better than expected, and no one wants to talk about that. He said analysts and investors have been so heavily focused on the macroeconomy and the trade war that slowing growth could curb lucrative deal-making for investment bankers and reduce wealth management assets and dampen load demand and all that stuff, that we're kind of going down this rabbit hole, but we're not focusing on what's right in front of us. And so far, it's good results. And he's right, by the way. There's a lot of politically motivated people, it's not me, but a lot of politically motivated people that want to dive into this for political reasons to go after the president or go after the GOP or whatever, and just make it seem like we're already in a recession or we're already, facing economic troubles. And right now we're not. I think there's a good chance that we do, but there's a lot of doom and gloom, right? And the result of that, too, is that there's a lot of companies that have been hit really, really hard that probably shouldn't have been hit hard in the stock market. I would say Google's one of them. They were hit hard. They sold off because of fears of a recession, because they're advertisement heavy with their revenue. Same thing with Meta Platforms. There's almost no direct effect on Meta Platforms from the tariffs. The expectation of a recession is what drove down the price of Meta. If you don't think there's going to be a recession, I'd say buy in. If you do think there's going to be a recession, actually, I'd say buy in anyways, because these companies in the long term are going to be fine. They're not going to go out of business. They're not going to go to zero. They're not going to stay beaten down forever. So why not? Why not? Even if we do have a back half of the year recession, which is actually what JP Morgan is forecasting for now. They say possibility of a third and fourth quarter recession, and they're looking at a potential of 5.3% unemployment, which is, comparatively speaking, to where we're at right now, like 4.1%. It's not good. But if it's only 2 quarters and we get out of it, we should have a V-shaped recovery as long as there's not unnecessary government intervention. Hopefully there's not. So JP Morgan addressed credit card default rates in its earnings report. They said that while credit performance remains in line with expectations, it has increased their loan loss preventions due to economic uncertainty. They boosted their unemployment assumptions to 5.3%. Not good. A lot of people kind of focused in on the loan loss provisions, but most analysts were pointing to it as them being prudent. I agree. I think JP Morgan is actually a pretty good solid buy right now. Price to earnings ratio is relatively low. I usually don't dive into financials because I'm going to be honest when I say this, it's not the right reason to not invest in something, but it's true. It just bores me. And the growth isn't always there, but I think for JP Morgan right now, if you want a safe place to put your money, it's a safe place to put your money. You're not going to get 1,000% over the course of 5 years, but it's safe. Michael Feroli, the U.S. chief economist for JP Morgan, said we now expect real GDP to contract under the weight of tariffs, looking for a recession in economic activity, looking for unemployment up to 5.3%. And then there was a broader report, too, that was issued that said that Americans are now defaulting on credit cards at record levels, highlighting growing financial pressure on consumers. JP Morgan left its forecast for net interest income, excluding markets, unchanged, and an encouraging sign for investors. So they left their forecast for the next year for net interest income. I don't know that that's so much of a positive sign to leave the forecast. I think it's just a sign that there's so much uncertainty that you just don't know. This isn't a situation that we're dealing with that takes into effect regular market fundamentals or regular market cycle issues. It's just not. This is all at the will of one man, the President of the United States. So, things depend on what he says on Monday, Tuesday, Wednesday, what policy reversal decisions he makes, and nobody can predict these things. You may think you have a good line on it, but you don't know 100% because nobody can read his mind. He's an unpredictable person. That's not always a bad thing for negotiations, but in this case right now, I think the market is kind of hanging on that. The fact that it's not predictable. And I think JP Morgan just kind of said, all right, we're going to leave our forecast in line based on what we were predicting before, because what we were looking at was, market fundamentals, things like the yield curve inversion, things like unemployment, all that stuff. We're not going to base a forecast on what Trump may or may not do in the next couple of weeks because we don't know what that is. And they actually, Morgan Stanley CEO Ted Pick actually said this. He said the simple truth is that we do not know where trade policy will settle or what the effects will be on the economy. We don't know. So they're not factoring this stuff in 100%. They may factor in later what tariffs have already been announced and just go with that. But right now they haven't really factored these things in, because they don't know what the effect is going to be, nor do they know what the extreme or less extreme side of the tariffs is going to be either. We have no idea where this is going to go from here. Now, obviously, I don't think it's a good thing when we look at Warren Buffett and Berkshire Hathaway and we see that they now hold more than half of the company's net assets in cash and treasury bills, when Warren Buffett himself has said, I prefer 100% to be in stocks, but he obviously doesn't see a reason to be 100% in stocks right now. That's kind of a scary sign to me. Like I said, I don't want to spread panic, but the fact that Berkshire is more in treasury bills and cash right now, and a lot of people listening to this might question that. Dave might even question it, but I think we're well beyond the point of questioning Warren Buffett. There's been so many times over the years that he has made a move that many people have questioned, and it turns out it was right. A lot of people questioned him buying Kroger, and Kroger was a good investment. Great investment, actually. A lot of people questioned him selling the top of Apple, taking some off the top of his Apple gains a few months ago. Turns out, so far, that was the right move. Now, I would buy into Apple right now, personally. I'm not going to, but I'm just saying, like, if that's on your watch list, if that's something that you want to do, probably a good idea. I have other stocks I'm looking at buying at right now. I'm gonna get into those at the end of the show. But yeah, so far Warren's been right. Why question it? I do want to say, after all that negativity, there are companies that are going to benefit from these Trump tariffs. It wouldn't exist if there wasn't somebody that was going to benefit, right? So I want to look at kind of the domestic steel market. Last week, I recommended Reliance on the podcast. If you were on the text, I actually said I changed my pick to Nucor. I didn't mention it on the show because I thought they were both pretty good picks. But Reliance did go up 7.75% for the week. I'd hold it. I like Reliance. They've got a strong balance sheet. But so far, that was a winner. Nucor is up 11% over the past 5 business days. Again, I would hold it. If you haven't bought Nucor, I think that's going to continue to outperform. Rio Tinto was up 2.83%, so not as good. Again, I mean, Rio Tinto, they have a lot of overseas mining. They're shielded pretty well from tariffs because they do businesses in the company or in the countries that they mine in. Not a bad pick there either. But I'm going to add one more to this, and that's Newmont Corporation. They're the largest precious metals miner based in the United States. They're a leading gold and copper producer with operations across the United States, Australia, Ghana, Peru, and Suriname. They have a significant presence in Nevada, here in the United States, where they operate as part of the Gold Mines joint venture with Barrick Gold. The precious metals are going to be a big deal here in the United States, and I think for President Trump and his tariffs, these precious metals are very, very, very important to the defense industry, to semiconductors, and all of that good stuff. I think Freeport-McMoRan is going to benefit from the tariffs. They primarily focus on copper, but they also mine gold. The rare earth supply chain, including 17 metallic elements critical to electronics, that's been a huge concern for the military and for civilian applications. I think that those minerals are in short supply. The Pentagon is going to be moving quickly, I think, to ensure that those things are not being sold to adversaries. And plus, we've had a Chinese export ban since December, and that's only kind of raising the stakes and boosting production here in the United States. Those are industries that I would be looking at. Agriculture and food production would be another one, U.S.-based food producers and farming operations. Archer Daniels Midland, I think, would be a good company for people to be looking at. They're on my watch list. I honestly haven't done too much of a due diligence into them except for just a glance. So, I mean, don't go rushing out and buying that stock just because I said it. But maybe, put that on your watch list, do some research, go to the chinchillapicking.com website, and, use that stock grading article that I have there to go through these industries: agriculture and food production, mining companies that are based here in the United States, manufacturing that's based here in the United States. Here we are. I'm changing the way I invest because of Trump. I didn't think that was going to be coming as the result of the heavy hand of a Republican president, but here we are. I'm not trying to be too political here, guys. I don't want to be biased. I don't want to be somebody who is alienating, people because of politics. I don't want that on the show. But I'm just giving you my particular opinion on this. And sorry, but it's right. Dave's not here to tell me it's wrong. So for right now, it's right. But that's all I've got for today. I hope you were entertained, educated, and uplifted. Don't care if you were mad at me. I hope it wasn't too bad. But have a wonderful week. I think that instead of just kind of beating a dead horse, dragging ourselves through the mud here, I think from now on we're just going to be looking at the Chinchilla Picking podcast and saying, hey, this is what you guys should be investing in. You've got my opinion on tariffs. You've got that out of the way. I'm going to try my best to not be so negative and try my best to not talk about tariffs anymore, other than what I think we could do to increase the money in our portfolios based on the current situations. You guys have a good night, and we'll see you next week.